With inflation high, the people who make big financial decisions in our country, called the Federal Reserve, have made borrowing money more expensive 11 times since March 2022. This is the fastest they've ever done. They want to do it again, which might affect your investments. Let's see how. Number 1. Bonds. Bonds are like lending money to someone. You're lending money to a company or government when you purchase a bond. In return, they promise to pay you back the money with some extra as a thank you gift, interest. Now, imagine you lent £100 to a friend, and they promise to pay you back with an extra £5. But suddenly, you discover that you could lend your £100 to someone else and get £10 in return. Your original deal with your friend doesn't seem great anymore, right? This is similar to what happens with bonds when interest rates go up. If you have bonds you bought a while ago when interest rates were lower, their thank you gift, interest, might be lower compared to new bonds issued with higher interest rates. So, the value of your older bonds goes down because they're less attractive to investors than the new ones. This can affect your investment portfolio, especially if you have a lot of bonds. Number 2. Stocks. Now, let's talk about stocks. These are like little pieces of a company that you own when you buy their stock. When interest rates go up, it can make it more expensive for companies to borrow money. Think of it as companies paying higher interest on their loans, just like when you pay more interest on a credit card when rates go up. When companies have to spend more on interest, it can eat into their profits, which might decrease their stock prices. But here's where it gets interesting. Sometimes, when interest rates go up, the economy is doing well. When the economy is strong, companies tend to make more money, and that's good for their stock prices. So, the impact on stocks can sometimes be clear-cut. Additionally, some types of stocks are more affected by rising interest rates than others. For example, companies in industries like healthcare or utilities that provide essential services often do okay because people still need those services even when rates increase. On the other hand, stocks known as value stocks, usually from established companies, might handle rising rates better than growth stocks, from companies expected to grow a lot. Number 3. Real estate. Okay, let's move on to real estate. When interest rates go up, it can make it more expensive for people to buy homes because they have to pay more interest on their mortgages. So, fewer people can afford homes, which can slow down the real estate market. If you already own property, though, there's a silver lining. When prices of everything are going up, inflation, it usually means you can charge more rent. This can increase the income you make from your property investments. However, it's worth noting that not all real estate investments are the same. For example, real estate investment trusts, REITs, often have long-term leases with tenants. This means short-term interest rate changes take time to affect their rental income. Additionally, when the economy is strong, there's more demand for properties, which can counteract the negative effects of rising interest rates. Number 4. Precious metals and commodities. Now, let's talk about precious metals like gold and other commodities. Imagine you're worried that the prices of things are going up too fast, inflation. You might buy something that always keeps its value, like a rare and shiny coin, gold. Many investors do this when they're concerned about inflation, and it can increase the prices of precious metals. If interest rates go up and people start worrying, investing in things like gold for a little while might be smart because these investments often do well during inflationary periods. Number 5. Money in the bank. Lastly, let's talk about keeping your money in the bank. When interest rates go up, the bank usually gives you more money, interest, to keep your money with them. It's like they're saying, thanks for trusting us with your money. Here's a little extra for you. But there's a catch. Even with the extra money, more is needed to keep up with the rising prices, inflation. So, while you're getting a bit more for your money, you might still lose some of its purchasing power because prices increase faster. In summary, different investments can be affected in various ways when interest rates go up. However, the key is to stay calm, stick to your long-term plan, and avoid making big decisions based on short-term changes in the market. Overreacting to these changes can lead to costly mistakes. Please like, share, and comment, and don't forget to subscribe.